Welcome back to the Series 7 podcast video series. This is episode 5, and in this episode we're going to continue our exploration and understanding of fixed income investments. So this is going to be part 2 of what may be a multiple part series to cover what you're going to need to understand for the FINRA Series 7 examination on fixed income investments. There's several debt issuers, and the largest is the U.S. Treasury, the U.S. government. And U.S. government direct debt is considered U.S. Treasury bills, notes, and bonds. But it may also not, it does not include, but sometimes it's inferred that it includes U.S. agencies there and these are commonly called government-sponsored entities, or GSEs, or agencies. And there are GNMAs, which are Government National Mortgage Associations, debt, which are mortgages. So these securities, unlike regular bonds, pay interest and principal on a monthly basis. So it's the opposite side of your home mortgage. Fannie Mae's, Freddie Mac's, Salliemae's. Fannie Mae's were the Federal National Mortgage Association. Freddie Mac was the Federal Home Loan Mortgage Association, and I didn't put the Federal Home Loan Mortgage Association in there. Salliemae is the Student Loan Marketing Association. Now, following the financial collapse in 2008, Federal Home Loan Mortgage Association and Fannie Mae were put into conservatorship in a new agency called the Federal Housing Finance Agency. So their debt was made good, as far as I understand, was made good, but us as taxpayers are basically bailing out their bad investments in mortgages over the years. You may or may not be asked about agencies. It used to be a big portion of the fixed income side of the Series 7 examination, and I'm not quite sure what they're going to be including on agencies such as Fannie Mae's, Freddie Mac's, Salliemae's. Now, Salliemae's are still in existence. These are the student loans, and GNMA's are still in existence, but Fannie Mae's and Freddie Mac's have been now put into the Federal Housing Finance Agency. Municipalities can issue debt, and they can issue it on a state, a county, or a city level. And then we have corporate debt, which is both domestic and international corporations can issue their own debt. And we have foreign government debt, such as bunds, sterlings, and so forth. A big issue on corporate debt, or pretty much any debt, you need to make sure you understand, is call features. And a call feature is the option of the issuer to redeem the bond at a specific price. It's not an obligation, and they're only likely to call a bond if interest rates drop and they can reissue or get the money back and pay a lower interest rate than they're paying the investor. So it's usually not to the benefit of the bondholder. And like we talked about in preferred stocks, it tends to put a ceiling price on bonds when interest rates drop, because if interest rates drop very far, if there's a call feature in the bond, it would keep the bond from rising to reflect the current new yield because of the risk of being called. When bonds are issued, they usually have a call period, a call protection period, and we will go into that further now. Now, U.S. Treasuries, direct U.S. Treasuries, not the agencies, but direct U.S. Treasuries are issued as non-callable. So U.S. Treasuries always trade on a yield to maturity basis. So traders like to trade U.S. Treasuries because there's not that uncertainty of being called, and also it carries the highest rating. U.S. Treasuries are considered risk-free. Now, we can have a big debate on that, but for purposes of the Series 7 examination, U.S. Treasuries are considered risk-free. A call protection period is a period of time that protects the bondholder from a call. So here's an example of what a call feature might look like. Let's say General Electric on January 1st, 2013 issues a 6.5% 20-year bond. Interest is paid semi-annually. Usually, and would just assume it's January 1st and July 1st. But they might have the following call feature when they issue this bond. Callable in 2016 at 104, 2017 at 103, 2018 at 102, 2019 at 101, and then on any interest payment date beginning the year 2020 or after at par. So there's usually a 4 or 5 year call protection period on any debt, and then they may exercise the option of calling that debt if there's an economic reason to do so. All right, let's look at this example and talk about what you would be talking to your client about if you were to quote him a bond that you buy on the secondary market, or that you're quoting the client on the secondary market. Let's say you're quoting a client a bond on the previous bond we just talked about, the General Electric bond, and you're looking at buying the bond. Now it's January 1st, 2014. It's trading on the secondary market. Interest rates have dropped a little bit, so the bond has got up in value. So you're looking at the bond price at 106. What you need to make sure, and this is very, very important, you need to make sure that you quote your client the most conservative yield, the worst case scenario, the worst possible interest rate that he would receive on that bond. Now, you can quote the other yields, but you need to make sure he understands the worst case scenario on that. Now, I used a bond calculator to calculate these numbers out. So these are the numbers and the call prices. So if the bond were called on January 1st, 2016 at 104, the yield to the call would be 5.22%. Remember, the coupon yield on this bond